Good morning, good afternoon, or good evening, depending where you are on the planet. Welcome to the Tuesday, the 11th of July, Bull versus Bear webinar. Steve Miley on the call here for Trade Day. Welcome, everyone. Welcome, guys. We're going to go through our usual run through in here today, what we've had, what we've got coming up. We'll take a look at the calendar, take a look at some articles from the major news wires, take a quick look at the charts. I'm going to make it fairly snappy today. So let's look back at the calendar before we look forward. So yesterday, really the focus yesterday was on various Fed speakers, Barr, Daly, Mester, Bostic. We didn't get anything too exciting, however, from those Fed speakers. So markets were a little tepid yesterday, muted, not much going on. And that wasn't just the stock indices that I know a lot of you guys are trading. You look at bond markets, they were quiet, FX markets were quiet. We said this would likely happen. We pointed out that we have this big piece of data on Wednesday, the CPI data, remember. And I'm not going to go through it again. This is one of our tier one pieces of data, CPI on Wednesday, no trading, no orders in the order book 2 minutes before or after the US CPI data, which is tomorrow on Wednesday. However, it's not Wednesday, it's Tuesday. So let's focus on Tuesday. So markets were quiet yesterday. I think we'll see markets fairly quiet in here this morning as well. Price action has been fairly tepid thus far this morning. Not too much happening across global markets in here. Bond markets are fairly stable. FX markets are fairly stable in here. Commodity markets are not doing a great deal in here. We do have oil slightly better and gold slightly better, but no real big moves. So, but let's take a look at them, what we've had. So yesterday was all about the Fed speakers. I got a couple little bits on that, but they didn't really tell us anything that we didn't know already. There is one little article in here just implying that they kind of started to hint that we're getting closer to the end, but equally hinting that, rates are going to stay higher for longer. So I think, the market needs to get used to rates are going to go up again and they're not coming down anytime soon, certainly not this year. So, and we'll take a look at the Fed tool as we go forward as well. This morning we have had some significant European data. So first of all, the data in here from the UK, we had the employment report. So the employment rate ticked up. The employment change was lower than expected on jobs added, and the average earnings, and this is, remember, even though it's in green, this is a negative, it's a positive for the currency though. Average earnings pushed higher than expected. So that's obviously a negative because that can fuel inflation. So that's a little bit of a worry. A couple of articles on this in here. So look, UK wage growth matches its record high, but jobs market shows sign of cooling. So I mean, that's kind of a positive that the market is cooling slightly in here on the job side, with the unemployment rate ticking up and the number of jobs added fewer, but that high level of average earnings is a little bit of a concern. So UK wage growth matches record high, can still be feeding into inflation. So that's a little bit of a worry in here. And the outcome of that is that the pound has hit a 15-month high. British jobs data reinforces rate hike bets. So, so then obviously, but stronger inflationary pressures because of the higher wage growth equals a potentially more hawkish Bank of England. More hawkish Bank of England leads to the currency rising. So hence the pound at a 15-month high. So we've got those two going on. I'm going to close these as I go. And then also Bank of England may need to keep rates higher for longer. So the IMF have been chipping in on this as well, talking about higher for longer within the UK. The other data we have in here is highlighted here. German investor morale falls more than expected in July. So actually, there's another important piece though. We had CPI numbers in here out of Germany as well. Came in though, bang in line with expectations. So no real impact from there. The ZEW though, the ZEW survey, part of it, slightly better, but some of it worse than expected. This is the one we really look at in here. The economic sentiment, and you see worse than expected. This is, remember, it's an investor survey. This is a survey of investors, and their outlook is not positive in here. The German ZEW survey, and also the European survey, you can see in here also a negative as well. There's the European ZEW survey. So those two are both negatives. The overnight positive that we had in here, and if I can just find that in here. So here's some of the comments in here about, look, so from European and US speakers more recently in here saying, that they're nearly finished. This is from the ECB actually, nearly finished hiking, that they will stay at a higher plateau. So more to come, plus staying higher, also coming out of the ECB, similar to what we're seeing, hearing out of the Fed. But the positive in here was China's stimulus boost. So from China, we got some news that European stocks advance amid China optimism, and that comes from them talking about support. But again, it's kind of vague in here. More economic support measures are imminent. What the measures we did get, a small step towards supporting the ailing property market, extending loan relief for developers. So they're extending loan relief for developers. So that was seen as a positive. Also talk of them doing more, but there's been lots of talk and no action so far. And obviously the Chinese stock market has been under more pressure recently, the Chinese currency under pressure. And obviously we looked at that data yesterday of the PPI and CPI numbers showing deflationary pressures in China. So slowdown continuing there, measures being promised, but then it has buoyed markets slightly in here this morning. So we've seen markets slightly up in here on the back of that. Let's go to the calendar and look what we've got coming up today in here. So US is light again, remember, ahead of tomorrow's big CPI data. Nothing really of note in here. I mean, we got the EIA energy report in here and the API, but I mean, these are not going to have big effects on any markets that you guys are looking at. Obviously, if you're looking at crude, it will. Bullard is speaking, but we've had a lot of Fed speakers. They haven't really had much of an impact recently. We know the mantra, rates to go higher, hike at the next meeting after the pools, almost certain now. We'll look at the Fed tool in a second. So nothing really of note in here. I expect, a similar trading day to yesterday, looking for the markets to be relatively quiet, looking for it to be more of a mean reversion day, not looking for markets to sort of, just run off in any one particular direction, either up or down. Let's go take a look at 5 things you need to start your day from Bloomberg. 3 Fed officials said yesterday that policymakers would need to raise interest rates further. We know that, right? So we've made a lot of progress. We need to do the work that we need to do over the last year. Michael Barr said, blah, blah, blah. We know all of this already. China aid, more economic aid measures will come to support the property market. We've already covered that. Buffett's Berkshire Hathaway Energy has agreed to buy Dominion Energy. Do we care? No. And markets are slightly better in here, or were slightly better in here. And what have we got coming up? Well, they've highlighted stuff in here, but there's nothing of real note coming up. So yesterday, markets were slightly up, nothing really huge though. Investors digesting the Fed officials' comments, which, just kind of telling us what they'd already been telling us previously. But maybe with the point of saying, they're going up, but they're not we're getting closer to the end, okay, of rate hikes in here. Futures head higher ahead of monthly inflation data. We know that's tomorrow. China, we've spoken about that as well. European stocks were higher, but parried their gains. European stocks advance amid China optimism. Same kind of stuff going on there. Bond yields recoil. So bond yields, this is interesting. There has been one little theme more recently. Obviously, the moves lower that we saw last week in stocks in here were primarily driven to the fact that we had more bullish data than we expected from the economy. And then that ended up sending yields to higher, breaking out of yield ranges. And then that had a negative effect, particularly on growth stocks, because growth stocks are more susceptible to higher interest rates. So growth stocks got hit more, and that meant the NASDAQ got hit more and pulled the broader markets down last week as we went to higher yields. But if we go and look at the yield chart in here, so this was that sprint to higher yields that we've seen really since the late part of June through early July. But if you look in here so far this week, in here, we've been recoiling back lower. So down in yield yesterday, down in yield. And if a quick jump to the charts in here, we'll see that the market, so not quite as obvious in here. Hold on, let me get to the right chart. There's the bond chart, 30-year bond chart up, yesterday and again this morning, 10 years, 5 years, same in here, 2 years, right the way across the bond curve. So it's showing you a potential reversal in your potential base. You've got this hammer pattern on the yield, on the price charts in here. And if we go back to the bond chart, you see more like a shooting star pattern in here. Actually, we didn't get the shooting star pattern back at the end of last week. But we certainly got the hammer pattern in here on the bond charts in here. This is on the 2-year. Not so obvious in here, but you get almost like a bullish engulfing yesterday from the 30-year, 10-year. It's just a very impulsive move up higher yesterday. It's just breaking out of you see in here as well, in here from the range at the end, this impulse range that we had at the end of last week, breaking out towards the top end of that range as well on the 10-year. So that's notable. So markets, we're seeing bond markets making more positive signals in price, which means lower yield signals and yields back lower, which should be supportive of stocks. So it should be positive for stocks. But then obviously the market's this is just really a correction of this move. More than anything, it's a correction in this move ahead of, no surprises, we're getting a correction in that move, seeing as we're going to a super important piece of data for the bond market, which is the CPI data. It is in the trading room. I'm going to go and get it because I don't want to go to the trading room, but we talk a little bit about this in the macro matters. So if I go to the macro matters from this week in here, weekly macro, I'm just going to go and get that in here and share the link with you. I'm not going to go into it, but we do cover that. So if you want that, I'll just put that into the chat, or just go here, or it is downloadable in the trading room as well, talking about the CPI data. What else do I have for you? Bonds recoil, big tech dominance in stock markets breakpoint. So exchange plans special rebalance to curb over concentration. The 6 largest members saw their weights rise above 50%. So the 6 largest members of the Nasdaq 100 in here now making up over 50% of the Nasdaq 100. So 5 companies making up half of the weighting for 100 compared to the other 95 companies in here. So potentially a special rebalance to redress that, the first ever of its kind. So that's going to have an impact on the market. So we do need to be monitoring and watching that in here. July 24th adjustment will address over concentration. So be aware of that coming up in here, guys. Okay, the market's going to start, pricing that in anyway. Okay, so it's not going to jump on that day, but you have to just be a little bit wary of as that gets priced in and what the potential implications of that. I've not actually read this article, so I'm going to go and read that article when we come offline to see what the implications is, whether it means it's going to trade heavy. It's probably going to trade heavy if they're going to rebalance, because obviously these are the winners, right? These are the ones that are leading the way higher in the market, and potentially lower as well. So we're going to see 6 largest members, not 5 largest members. So I'm going to take a look at that one. I'll see if there's anything interesting there. Well, maybe we can talk about that tomorrow. And oil, just a quick focus on oil. Oil steady. China takes steps to revive ailing economy in here. So that positive for China equals positive for oil. Run through where we are overnight on other exchanges. Japanese stock market fairly unchanged. Hang Seng did get a bid. So remember, this is a reflection of the Chinese economy, Chinese stock market, and that's getting a bid on the back of that positive, potential positive steps and support for the Chinese economy. European exchanges, the FTSE is slightly lower in here with that kind of, if anything, you would say it's negative data come out from the UK today. That wage data in here, stronger pound will weigh on the FTSE 100. But you see in here with the broader positive outlook coming through from China and the positive close that we saw, slightly positive close on the US stock indices yesterday. The German DAX and the French CAC indices are up. And if we go and take a look at the US in here, obviously we were slightly up in here yesterday in the US. And if we look at, once it does load up, the futures in here this morning, we're going to look at the charts anyway. Once it loads up in here, you can see we're slightly up, okay, with those European markets, with those Asian markets, with that positive news following through from yesterday, plus the positive news out of China. We've already looked at. Oh, actually, did we look at this? No, we didn't look at this. So this is continued to push up in here, 95% now. So pretty much nailed on a hike at the next meeting. But if we go out to the end of the year now, the market's still not convinced there's going to be another rate hike. The market is really convinced it's going to be. We've been a series of rate hikes. We paused at the last meeting, one more and done, because we've only got a 30% chance of them, over here, just over 30% chance of the Fed hiking again, okay? And you've got like a 16% chance or just over of them actually cutting rates from the next rate hike. But, really the market's just expecting us to stand pat. That's where we are going into the end of the year. So it's going to be interesting because the market's probably, the Fed are basically telling us 2 more hikes, right? And the market doesn't really believe it in here. Just to nod again so that we do get later this week, So PepsiCo kicks off on Thursday, but really in earnest, we get the earnings season coming from Friday. We'll cover that as we go forward. We've spoken about the yield charts. A quick nod to so we looked at the charts there on the bonds in here. Quick nod to oil and gold. So oil in here did dip lower yesterday, but it's been in a really strong move back higher in here since the supply cuts from OPEC announced at the beginning of last week, pushing above various resistance points in here. We had a slight dip, but then a rebound today on the back of that China news. All risk for me is back up to the peaks in here, the recent peaks, back up towards 74 on oil. And then if we go take a look at gold as well, gold in here, it's trying to form a base. So we are just nudging above this kind of range peaks in here. We've got this kind of like sort of like a doji pattern in here, rejecting the downside a week and a half ago. And then another rejection in here at the end of last week, beginning of this week. And now the market, it's forming this base by pushing up above these resistances here. If I step in on gold, you can see in here, it looks more like a base here. We go on to the 15-minute chart. You could argue it's a inverse head and shoulders, right? I'm actually going to take this out. It's already on the 30-minute chart. I'm going to take it out to a 1 hour chart. I'll just show it a little bit better, I think. If we go and say, look on the 1 hour chart in here, it's kind of like, not perfect, but like inverse head and shoulders, where you got the head here. Quick little bit of analysis. I haven't done a bit of analysis with you guys for a while in here. So here we go. We'll draw so like the head there, kind of shoulder here, and then the other shoulder over here, and then there's various places we could put the neckline in here. But, I'd argue it's between the points from the two shoulders, so it'd be come across here and across here. So we'd already broken it. You could argue it's more flat across here. So I'm going to draw a couple of potential necklines in here. So this one's already gone. If we have this one through here, I'm going to draw it properly by extending it out. So you should do it, guys, by the way, right? So you put it on the 2 points and have it extend out. Don't do the freehand in here. Don't just like going and put it over here and trying to clip it to this point. Clip it to the actual point proper and then have it extend out. And you see it works really well, this one. So this is probably the genuine neckline because you go draw it through these 2 points. And you can see it respected it a day or so ago, came back down and went again. You've almost got like a double shoulder, right? So you've got the shoulder here and the shoulder here, but you've got another little shoulder here and see this one over here as well. So it kind of works as like a double shoulder. And this happens quite a lot. You get like the double shoulder, or sometimes you get a double head, right? So you got like this smaller shoulder here. Oh, if it'll allow me to put, oh, no, you don't want to go in all the way over there. Let me move that. See if it'll allow me to move it. I'm going to make it smaller just because it is a smaller shoulder. It doesn't let you dupe them, does it? No, of course it doesn't. And then we can have another little one over here, right? So you got like a double shoulder here, and the head down here. You've almost got like a little inverse head and shoulder. You see down here as well? There's almost like a head and shoulders within the head. So you've got a little shoulder here and another little shoulder here with a neckline running across there as well. Stick that neckline on. You got like another little neckline on so you got inverse head and shoulders within the head itself, and then you got double shoulder over here. I think that neckline really works well, but even if you put the other neckline on, which is more the horizontal one that runs more like across there, look, we're flirting with that one right now. So if we can break here, then you got these spike highs up here. I know I'm taking a bit of time on this, but you got highs up here. I think it's a good bit of analysis. Show you how I do my analysis anyway. I know it's on the longer chart and a lot of you don't even trade these charts, but that high up there is 49. So up through 49 would reinforce this whole basing pattern. So yeah, upside pressures there coming from gold, potential reversal. I know I've got one of my, on like our sister site over here, this is another site that I own, broker site, broker affiliate site in here. We've got this one in here from Richard. So I'm going to share that as well. What is needed for gold to rally again? And he's looking at the technicals on that, and also some of the, what's going on CPI data, what's going on with the Fed, what's going on with yields, what's going on with the dollar. And this comes from Richard Perry. He's a good analyst. I've known that Richard a long time. So take a look at that one as well. What else do I have for you? Let's go back and have a quick nod because I'm sure some of you want to look obviously at the indices. As I say, I think now the market's kind of poised. It could go easy, go either way. But we did get this kind of hammer pattern in here. So on the S&P yesterday, so kind of a downside rejection hammer pattern came off above this little support over here. We'll look at that again in the shorter term chart. I'm going to zoom in and see what we need to do on the upside now. So I've been hanging on to a positive leaning anyway. If we go and look over here, so it comes off of this kind of support here. Let's see, just this low here. It sort of defends that low there. And also you got the 61.8% retracement. So it kind of defends this 61.8 and it certainly defended that low over there. That lower 44.0975 coming from above that. Critical for me now, so you get that kind of, that's what creates that hammer pattern here. Really it's just, I'll be looking at the down trend line that comes through here, through the peaks here. So it really needs to clear that to be more bullish. The initial line in the sand is above the recent overnight high. So that's 55 and a quarter. But, if it can clear above here, which is up at 61.62, the trend line, if it can clear above 61.62, S&P looks a lot stronger. Let's have a look at the NASDAQ. Similar thing in here, hammer type pattern in here, or dragonfly doji, really. So setting up the more bullish tone. Again, really rebounding above these two lows in here. Look. Okay, and if we go again in here across to the two lows, above this retracement here, 61.8% of this whole move in here, and these are these two lows, so they're coming in around 15.028 and a half, 15. What's this low here? 21 and a quarter. So 28 to 21, 15.0, 28, 21 was support, and we're rebounding from way above that. There's the trend line. It's already on there. And I'm just going to, actually going to delete that and draw it properly and actually extend it out from the peak through the peak. And it extends out. So, above the overnight peak in here, initial trigger, you want a more bullish signal. That's a 238 and a quarter, but the trend line's all the way up here, right? So really you want it through, it's like nearly 300. Okay, if you want something ahead of there, you'd probably be looking at the retracement levels, right? And remember, multiple retracements, both the retracement off the high. Okay, actually, let me reverse this because it does it the wrong way around, in my opinion, having done this for 30 years. So we've got a 50% there, and then I'd also put on the retracement of the move, the more recent move here. Okay, so look at that 50% and the 61. So the 61.8% of this move and the 50% of the whole move are almost coincident, right? And you've actually got that old little peak there, that little swing peak as well. So around 15.245 to 250 is going to be a key area. 245 to 250. Above there opens up quickly, I think, up to, then you've got the 61.8 and the trend line coming around the same area. That's going to be 15.290 to 300. So those are the two trigger points in here, 245, 250, and then up here at 290 to 300 in here, your upside trigger points on NASDAQ. All right, any questions? I'm going to wrap it up there otherwise. No questions? Anyone? Don't see anything typing. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another bull versus bear webinar tomorrow. Bye.